Hello, and welcome to the Dr. Money Matters podcast, the show where we discuss important financial topics that were never covered in med school. I'm your host, Dr. Tarang Patel. Are you looking for passive income? Are you afraid of putting all your investment eggs in the stock market? Have you ever thought about buying real estate as an investment? My guest today had those thoughts when he decided to get into real estate investing after the economic downturn of 2008-2009. Dr. Kenyon Meadows is a radiation oncologist in Southeast Georgia who branched out his investments to include real estate in the form of single-family homes, hard money lending, and crowdfunding. Many working healthcare professionals think that it's probably too difficult and too time-consuming to get into real estate. Listen to Dr. Meadows today, and you'll be inspired to branch out of the traditional investing mindset. All right, welcome to another episode of the Dr. Money Matters podcast. Our guest today is Kenyon Meadows, MD. Dr. Meadows is a radiation oncologist in Georgia. He went to undergrad and medical school at Case Western University in Cleveland, and then did his radiation oncology residency at the University of Florida. He practices currently at Southeast Georgia Cancer Care Center and is also the president of Meadows Enterprises, which is his own investment firm. Dr. Meadows, welcome to the show.
Thanks for having me, Frank. Appreciate it.
So I heard Dr. Meadows on another podcast, a real estate podcast, and I thought it'd be great for ours. So the reason we brought him on is because he has a lot of experience with real estate. So Dr. Meadows, let me ask you, investing important to you as a physician in general?
Well, first of all, I think we're all in a very advantageous position in that, physicians earn well. And so we generally have some extra capital around to invest. And so I thought it was just a good idea to educate myself on some more options than what are traditionally taught to us. And I will say this too, up until about 2010, I was a fairly traditional investor in terms of the various asset classes I participated in, stocks, mutual funds, some tax-free bonds, things of that nature. But honestly, after the 2008 downturn and then some other downturns in my portfolio, it got me thinking about learning about other assets, alternatives as they call it. And so that's what I've been into in a big way, including real estate, which is a big part of that. Okay, so good. Let's talk about that. So you mentioned that before 2010, you were a conventional investor like most physician dentists are, and you got into real estate and then other assets. So talk about real estate specifically. You've been doing that since 2010. What kind of investments are you doing? Yeah. So when I first got involved, my goal was to participate, but to be able to do it in a relatively passive way. I think most of us, when we think about investing in real estate, probably owning income producing property is the first thing that most of us think of. And that certainly was my thinking, but I didn't want to be involved in any potential hassle of managing a property. So actually my first foray into real estate investing was private mortgage lending. And what that is basically is when an individual, as opposed to a financial institution, provides the capital to another real estate entrepreneur to acquire a property, potentially renovate it, sell it, fix and flip, as we say. So that actually was my first entry into real estate, doing that.
Okay. And how did you, that doesn't sound like an easy thing to do. How did you find the people to loan to? How did you set up the infrastructure to do that?
Well, you're right. There's not really a standard, way to get into it. Basically, I began to ask around anybody in my network that I knew, like, hey, how do you invest in real estate? How do you deploy your money in a way that's different than the traditional ways that we've been taught? And honestly, it was really sort of a chance encounter with somebody at church, of all places, and told me that they loaned money to a rehabber, as it were, a fix and flipper. And he told me the basics about the process. And then I wound up meeting with that person, learning what private mortgage lending was about, and then also importantly, learning about other people that have participated in deals with them and had a good outcome. So track record is key. Anybody that you're going to be providing private mortgage money to, they really should be experienced and have done several projects with good outcomes that can be verified.
Right.
As a starting point. Yeah, definitely.
Okay. And so this is someone you met, like you said, at church. So obviously that generally is a good starting point. But,
Right.
but so you started with loaning to a rehabber. What did you do next? How did you go on from there? How did you evaluate the performance there? And then how did you go on investing?
Yeah, when it comes to private lending, I think many people in the audience may be familiar with a lot of the flip these house type shows that really proliferated prior to the mortgage crisis,
Right.
when it seems like everybody was doing that stuff. So I think people understand the basics. You buy a property that's undervalued, you renovate it to varying degrees, and then you sell it usually to a retail buyer at the end. So obviously finding a property that's very undervalued and making an aggressive offer where there's a lot of meat on the bones or profit potential when you judge how much you can sell it for. So, that person's got to have a good eye to know what's a good buying price. And then number two, what the amount of renovations are needed and what that cost will be. And then ultimately what that sales price will be afterwards too. That'll be attractive, or it'll attract a lot of interest, but there'll still be sufficient profit to pay your private lender. And just so people know, when you make a private loan to somebody, it's very, very different than a bank loan, right? So these loans are like 6 to 18 months duration. So that's relatively short. Mm-hmm. And the interest rates you charge on them can routinely be, double digits to mid-teens. So personally, myself, I've loaned money out at anywhere from 10 to 15% interest. So the person's got to be able to satisfy that, your requirements and still make a profit on their end. So being able to judge all that stuff accurately is key.
Right. Okay. And so you said you started doing that. Do you still do that as well? Or?
Yes, I absolutely do. As I continue to evolve in my real estate knowledge and investing knowledge, eventually I got comfortable with the notion of being able to own the actual property. Now, doing the private mortgage lending is good in terms of, getting a nice high yield on your money that's well above the rate of inflation. Right. But, then you start to think about things like, well, there's no inherent tax advantage to it, for say. So you're going to get taxed at your regular income rates. And as I began to consider that, and then looking at the tax advantage position of owning the actual property, I got comfortable with that too. And the way that I got into it was, one of the people that I was loaning money to, they were actually building up a rental portfolio. And they said to me, hey, you ought to consider this as well. And then when they really showed to me how with a very good property manager, and I emphasize good property manager, and with well-screened tenants, you can actually own rental property and have it be a relatively hassle-free, low time intensity investment. And what they call it is turnkey rental investing. And basically what it is are these companies out there, they specialize in, they market to folks like physicians, dentists, other high-income professionals. They want to own real estate, but they don't want to get caught up in the minutia of having to manage it. And so I basically linked up with a good turnkey provider and started building a portfolio that way as well. That was kind of the next evolution.
Like you said, there's a lot of these kind of companies. Have you, and you hear horror stories about these things. Have you had any negative experiences?
Thus far, no. I mean, I've had some of the typical things that are going to occur when you own property over a number of years. I mean, of course, There's going to be some repairs. There were a couple tenants who left a little earlier than their lease said they should, that kind of thing. But again, the property manager has they do a really good job of, number one, communicating with you, and basically, you just kind of you make an executive decision, and they kind of execute on it. So you don't have to really delve into it in terms of you being on the boots on the ground dealing with it.
And so getting back to something you mentioned a little bit earlier, like you said, the initial private mortgage lending, obviously you get taxed on that as your regular income, which for most of the audience, once they're attendings or practicing in their field, is one of the higher tax brackets.
Absolutely.
And so, as you said, the other aspects of real estate have some additional benefits, including the tax. Can you go into a little bit more about that?
Well, sure. So, rental income income, generally speaking, any of the expenses that are associated with owning the rental property, such as taxes, insurance, your debt service, really anything, you can write that off as an expense. So that goes right against the rental income, bringing down your actual basis on which you're taxed. And then, something I didn't really appreciate, but as you start to build a portfolio, it starts to become a significant thing, is this depreciation factor. And basically what this is essentially, I guess you call it free money in a way, because you don't actually even have to outlay any money to get this. Basically, the government allows you to depreciate your rental property on a schedule over a number of years, and you get to take that amount off as well. And so that's a nice savings every year. So that's pretty big. So when you take that into account, and then also the account leverage, where you can borrow 20% down to control the asset as well, and then all the debt service is something you can write off. There's some tremendous tax advantages with actual ownership of property.
Right.
Sure.
Let's go a little bit more into that, the leverage part. So like you say, for investment properties, you generally putting a certain percentage down, whether it's 25, 30, whatever it is. But then that magnifies your returns, because obviously you're getting the appreciation of the full asset. And your income, like you said, you've basically, whatever your net income is after all your expenses, and with depreciation, you might even have a negative.
Exactly.
Good.
Mm-hmm.
Okay. So those are the things I want to get across to the audience, because those factors together with the leverage and with the tax benefits make real estate a much more powerful asset than what you normally think when you're thinking, well, I'm making 5% or 6% on the return, as opposed to lending money out, like you were talking about, double digits, or stock market maybe getting 9% or something like that. I think, like you said, those are very underappreciated aspects of investing in real estate.
Right. And of course, we think about our 401ks and other tax deferred accounts as being the way to beat the tax man. But, again, with the ownership of physical property, you can get a lot of those tax advantages and also have access to the money right now and do something with it.
Like you said, you're still doing the private lending. You're doing single family homes. Are you doing other like multifamily units as well? Or
no, I started with single family, honestly, mainly because my mentor, as it were,
mm-hmm.
that's what they were doing. And so that got my comfort level to go there. Now, as I've studied the advantages, the pros and cons of single versus multifamily, I'm content right now to continue to build the single family portfolio. Now, when it comes to multifamily, there are certainly economies of scale and other advantages that go along with it. But for me, the thing that I found, and has been verified when I talk to people who've owned both asset classes, what you find is that the single family renter, a lot of times it's a different profile of renter than somebody who's going to rent an apartment. We do 3 bedroom, 2 bathroom homes, and we tend to attract small families to that's our typical renter profile. Right. And number one, they stay for a lot longer in place than a typical apartment renter. Okay.
Right.
I'm coming up right on about my 3-year anniversary of buying my first rental, and the same tenant is in that first rental property.
Wow.
And it's nothing to have somebody rent a single family home for multiple years. So the vacancy rate is definitely lower when you do single family homes, and vacancy and turnover can be your biggest expense. It can be if you don't have any big repairs.
Right.
So I like that. And then also the single family home renter, they tend to take better care of the property, because although they're a renter, just like an apartment person, they tend to feel psychologically more of a sense of ownership over it. And so they tend to take care of it better. So the maintenance things tend to be less too. So for somebody like myself, who again, I want the benefits of real estate ownership, but I don't want a lot of hassle.
Right.
I'm content to continue to build the single family portfolio, to be honest, at this point.
So you said you started that aspect 3 years ago. So do you mind me asking? You said that was your first one 3 years ago. How many do you have, and what are your goals?
Just in a couple months ago, we got our 7th property.
Okay.
And as far as goals go, it's kind of arbitrary. I'm thinking at like 15 to 20 would be nice to build slowly over time and have them eventually be paid off and have that represent a nice chunk of of my retirement income coming in from that, in addition to, of course, the traditional vehicles through work, the 401k and that kind of thing. Yeah.
Okay. And so now is your portfolio pretty much in the Southeast Georgia area where you live? Or?
Yeah. So, I tell people I'm on the coast of Georgia, an hour south of Savannah and an hour north of Jacksonville in Brunswick, St. Simons area. And my investing in terms of owning the rental property has all been in Jacksonville. And that was largely due to the fact that, again, my mentor and person who showed me the ropes, that's where they were building their portfolio. And so, and it had adequate inventory of the type of properties we target there. So that's
one of the other things that, remember, you had mentioned when I heard you on the Bigger Pockets podcast was the other aspects of real estate investing, such as crowdfunding and things like that are relatively new. Talk about your experiences with that.
Yeah, so the crowdfunding basically represents an online way to do the private mortgage lending in all fundamental aspects. One of the barriers to doing private mortgage lending is that you're supplying usually the whole amount of the loan to acquire and potentially renovate a property. So, you're going to write a high 5-figure, 6-figure check to do that. And obviously, even amongst us physicians, you may not have that amount of capital liquid to do that kind of thing. Mm-hmm. So the crowdfunding, the thing that's kind of cool about it is that it allows you to participate in a private mortgage loan for a fix and flip project, say, for instance, but you can contribute a fraction of that. A typical investment minimum on a crowdfunding site is like $5,000, and I've seen them start to creep downward now to like $1,000, and there's even one site I saw where the minimum's $100. So what it's done is it's taken the barrier of entry to private mortgage lending, it's taken it online, and it's lowered the amount tremendously where you can pool your money in with other folks and participate. And you still get the same high interest rates, 9 to 14% is a common range. And so, and fundamentally, it's all the same thing.
As far as that goes, are there any downsides, to these crowdfunding sites that you can see as opposed to going yourself? Obviously, the upside is you get a much better distribution of risk. Correct.
Well, the downside, when I do my private lending in the offline world, mm-hmm. You are able, and I was doing this at the beginning, when I would meet up with one of my partners, I'd actually go and see the actual property we were going to acquire. I would look at the neighborhood, look at the comparables, and kind of get comfortable with the notion that the ultimate sales price was going to be accurate. You can kind of do your own due diligence when you're doing it in the offline world. One of the things you have to be comfortable with is that the crowdfunding platform is doing that for you. Now, they provide all of the digital documentation for you to do a digital version of that. They'll show appraisals, they'll show comparables, they'll tell you what the track record of the developer is and all that. But ultimately, it's a computer screen. You know what I mean?
Right.
And you have to be comfortable that the platform is doing their due diligence, and that's the value proposition they bring to it.
One of the things that I think may be a problem, and I'm not sure, because I myself have not done the real estate crowdfunding sites, but if you're investing in multiple states for that, does that become an issue in terms of just if you're investing $100 here or $1,000 here, you may have 12 states worth of returns, tax returns. Is that an issue? Or is that just me thinking?
Well, it is. So for each project, you get a separate statement, and the sites, I think, recognizing this, they do a good job of packaging the statements for you when it's tax reporting time, and they make it pretty easy to forward on to your accountant and everything. But yes, the tax treatment can get a little complicated. And that's, no doubt.
So just if you're down to the $100 per investment, it may be a little bit of a consideration. So
exactly.
One of the things that I think many of us are, we're very reluctant about real estate because, like I said before, we've all heard the horror stories. I'm sure, were aware of these things beforehand. But what made you just decide to go for it? What was that thing that, drove you that said, you know what, I'm going to take that risk?
Well, honestly, some battle scars on the traditional investing front. So, I think everybody, the market downturn in '08 was pretty severe. So I think everybody got hit pretty hard there. Okay. Right. Now, after that happened, I did what I thought was a conservative rebalancing of my portfolio. I said, hey, what should I invest in that's just solid and, should produce nice steady returns, maybe not spectacular, but something steady and may not be subjected to such a severe downturn. Well, I said, hey, oil and gas, right? So on the heels of '08, I went pretty heavy into oil and gas, and we see what happened there, right?
Right.
So, when you have some experiences like that, all of a sudden, some of the other unfamiliar things, they start to look a little less scary. Mm-hmm. When the conventional stuff that you've kind of been shepherded towards, when you get burned that way, it gives you a little courage to try the other stuff. Right. Is what I'll say.
Right.
Yeah.
Good. Mm-hmm. Good. But you still are investing in the stock market and things like that. It's not like you've gone totally away from it.
No, I haven't. But I will say this. Most of my exposure now to the traditional equities market, it's almost pretty much exclusively through the 401k at work. I used to invest a fair amount of discretionary money above and beyond that, and most of that now has gone to these alternatives.
And I'm assuming that it's going well for you because as you said, you're going more and more towards that. So any concerns about the real estate market in the short run?
Well, timing plays a big role in everything, and so the 2008 market downturn, that brought prices down, that eliminated a lot of people went belly up, and so the real estate market was at its down point. And again, I didn't really start participating in any meaningful way till 2010, 2011, and we've been in a pretty benign cycle as far as the real estate market is going because it really only had one direction to go for a while, which was up.
Right.
And now I'm starting to see things like, the volume of house flips is starting to approach what it was before the crisis and some other things. So I'm starting, maybe we're getting a little frothy at the top of the real estate market as well. So, that's a cause for some concern. Yes.
Although, what they talk about generally is real estate is more local than national. So talk about your area. What do you think, is that the same thing you're seeing in your area, like Jacksonville area, or any difference?
Yeah, I have seen some. And so what we target are basically modestly priced single family homes in what we call B-level neighborhoods. And what we mean by that is the A-level neighborhoods, those are the very expensive properties, the beachfront stuff or the stuff in the very best school districts, the McMansion kind of thing. And then on the other end of the spectrum, you've got, very inexpensive properties in, kind of maybe crime-ridden or dilapidated areas on the other end of the spectrum. So we target these middle-of-the-road type of neighborhoods that have a nice balance of renters, homeowners, working class folks, that kind of deal. And since 2014, when I've been buying, I've certainly have seen the prices that we're paying go up over time. And there's definitely a lot more activity going on there. So I'm seeing that. Okay. I wouldn't say it's overly heated, but it certainly is trending upward. So yes. Okay. Yeah.
So are you seeing that your cap rates and things like that are trending down, or have you been able to adjust your rental amounts to kind of go with that?
Yeah, I would actually say in my personal experience, it's been able to balance out. You may pay a few more $1,000 to acquire the property, but yes, like the rental rate might be $100 or $150 more per month. And so, I think it's balanced out because there's definitely a demand for rentals. There's no doubt about that.
Talking to our audience here who may be invested and are wanting to start investing in real estate, what are some resources that you would suggest to them to kind of get, some knowledge?
If they're more book or audiobook type folks, I think the Robert Kiyosaki Rich Dad Poor Dad, where he really, I think, reorients you in terms of your relationship to to capital and money and cash flow and time, that kind of thing. Mm-hmm. And that's more of a mindset book than a real estate book, although there is some real estate stuff in it for sure. Yeah. And then there's another great book by a gentleman named John Schaub called Building Wealth One House at a Time, who's a big single family portfolio holder. So I think that's great. And if folks are more in the podcast online space, of course, I got to give a big shout out to Bigger Pockets.
Right.
And I mean, just tremendous amount of resources on there. And I kid you not. I mean, if you really spent some time reading their forums, there are some high level people in those forums that are doing some great things and giving out a ton of good advice and resources there.
Absolutely. Would you would also recommend if they want to just kind of get their feet wet a little bit, maybe starting into these crowdfunding sites as well? Yeah,
absolutely. I can throw out a few sites that I invest on, mm-hmm. but you definitely got to do your due diligence and just learn about private lending in general beforehand, and just be sure you understand what exactly you're doing. Mm-hmm. Mm-hmm. Yeah.
Right. And I want to talk a little bit about your investment company, Meadows Enterprises. Tell me kind of how you formed it, what your goal with that is, and just a little bit about it.
Well, yeah. So, when you hold investment property, they say it's a good idea to have it separate from you, because there's this liability thing where right. A tenant slip and fall, that kind of thing. So so number one, an asset protection thing to push these rental properties into in that regard. And then number two, I have raised some of my own private money from initially friends and family, and then more recently a few colleagues as well, to help me acquire some of the properties. Mm-hmm. And so just wanting to have a formal structure that was separate from me for them to invest in was really the main reason for setting it up.
Well, I think that's a very good overview of your real estate career. So tell me a little bit about your radiation. Oh, sorry. Go ahead.
Yeah, can I put in one more quick plug for an
Sure.
educational resource?
Yeah, absolutely.
So if folks go to my site, which I know we'll talk about in there, alternativefinancialmedicine.com, mm-hmm. there is a free ebook where I talk about specifically the turnkey rental property. I cover things like how I select a market, my buying criteria for a property, pitfalls, things to look out for, and also show the financial performance of a property for a year as well. So that's available for people too.
Oh, good. Okay. One more time, the website was?
Alternativefinancialmedicine.com.
Okay. Perfect. Mm-hmm. Perfect. Okay, great. Mm-hmm. So when you're not busy with your medical practice and your real estate, what else do you do?
I've got two girls, age 10 and 8, and they keep me busy as ever, particularly on the weekends. I believe it or not, I still do some online gaming. I'm a Call of Duty and Battlefield kind of guy.
Very nice. Very
I like to do that from time to time too. And my wife, bless her heart, she forces me to travel. I would probably work too much, but she makes sure we get out and see some of this great country, and more recently the world as well. So
very nice.
Yeah.
Very mm-hmm. nice. Well, you're a radiation oncologist, so you do have a little more free time than. I'm a radiologist. I can't say too much either. But
nice.
Very, very nice. Well, I want to thank you for coming on the show today, Dr. Meadows. And like you said, alternativefinancialmedicine.com is your website, and our listeners can go there and get your free ebook. And we wish you luck, and I'm glad you gave us some positive information and strategies about real estate, and we'll kind of continue to follow and see how things go, and let us know, if there's any updates that you want to give our audience as well.
Absolutely. And again, I really appreciate you having me on.
All right. Thank you.
Thank you.
I want to thank Dr. Meadows for being our guest today. He gave us great information about starting in real estate investing. Real estate can be a great way to diversify your investment portfolio. There are some real profits to be made if you invest at the right time and the right locations. It can be a great source of long-term passive income, but it's not very passive at the outset. As a high-income healthcare professional, make sure you protect your assets before you begin buying individual real estate properties. As I said, timing is key, and we've had a long run of very low interest rates. I don't know if the rates are going to go up anytime in the short term, say the next 2 to 3 years, but they're likely going to go up in the longer term. This low interest rate environment has pushed many asset classes to higher valuations as investors are looking everywhere for yield. I encourage you to be extra cautious and really do the due diligence before you put your money into any investment. If you're interested in learning more about Dr. Meadows and his company, the website is alternativefinancialmedicine.com, and you can also get his book called Alternative Financial Medicine on Amazon. There's a link on our show notes. As I said before, you can follow our show at Twitter at Dr. Money Matters, at our Facebook group, Dr. Money Matters, all spelled out, or on Instagram at Dr. Money Matters, all spelled out. I encourage healthcare professionals to join our private Facebook group, and we'll discuss some of the topics that we've discussed on the podcast in further detail. If you enjoyed this episode or any of our previous episodes, please leave us positive reviews on Apple Podcast, Google Play, or Stitcher. And any constructive criticism I would appreciate at comments at drmoneymatters.com, all spelled out. As usual, please remember that what you've heard on this show is for your entertainment and education only. Please speak with the appropriate experts prior to making decisions regarding your own financial situation. Thanks again, and look for our next episode coming soon.